Hello, good evening. I'm Erica Belay. Thank you so much for joining me. I'm going to wait just a second to see if some more people pop on. But whether you're joining me live or joining the recording of this later, thank you so much. I'm Erica Belay. I am a mortgage loan officer for Best Life Mortgage Corporation. My company is a brokerage, and I have access to about 20 different lenders that can do all different kinds of financing. And I would love to be able to help you with your financing needs. Just a little bit about me. I grew up in New Braunfels, Texas, born and raised New Braunfels, Texas. I currently live in Kyle, Texas, but I can do loans anywhere in this state. I typically focus most of my business along the I-35 corridor between San Antonio and Austin. But if you're anywhere in Texas, I would love to be able to help you with any of your financing needs. Tonight, I am going to be talking about how to finance a short-term rental. So let me jump into the presentation here. Excuse me, I do have a little head cold tickle in my throat going on, so I apologize if I'm coughing a lot. All right, so the short-term rental, where to start? In recent years, the popularity of short-term rentals has increased drastically. And why is that? Well, if you can purchase a property in a desired tourist destination, or even in areas that are seeing growth, instead of charging just the monthly rent of a long-term rental, short-term rentals offer the ability to change the rate as the market appreciates, instead of waiting for a lease to end. The ability to do this can also offer a lot higher profit than traditional rentals. So imagine a short-term rental with a rate of $200 a night is only occupied 50% of the month. So that's like, say, 15 nights of the month. That's about $3,000 a month in rental income. But then imagine that same property was a long-term rental at $1,800 a month rent. That's a $1,200 difference, and that's only at 50% occupancy, totaling in about $14,400 profit for the year. So obviously you can make a lot more money with short-term rentals. Now there is a little bit of a bigger risk, and so that's a little beyond the scope of what I'm going to talk about tonight. But the income earning potential of a short-term rental is amazing, and especially with online platforms such as Airbnb and VRBO and the popularity of those, it's making it a lot easier for investors and for vacation goers to find these short-term rentals. So really now we just need to consider our options for financing a short-term rental. Knowing how you can get approved for your future investment property is at least half the battle of buying one. So what are my options? Over the course of this seminar, I'm going to go over some of the different financing options and how the rental income can be used to help you qualify. There are a host of different options for different purchasing scenarios. So we'll be specifically going over the conventional loan program, FHA loans, VA loans, and then some of my investor loan products, such as debt service coverage ratio loans. And then I'll also talk about qualifying using the rental income. Now, a lot of people don't realize that you can use traditional financing to purchase investment properties. Now, there are definitely some stipulations there. For instance, it is illegal to say that you're purchasing a property as your primary residence and then use it as an investment property. So you have to disclose when you are taking out your financing what your intention for the property is. But traditional financing is an option. And by traditional financing, I mean conventional loans, FHA loans, VA loans. So let's start with the FHA home loan program. The FHA loan is designed for loans for borrowers as a primary residence. Same thing with the VA loan. But you can purchase an investment property using an FHA loan if that property is a 2-unit, 3-unit, or 4-unit. So you can use traditional financing for up to 4 units. But if you want to use an FHA loan, you would have to live in one of the units. So if you buy a duplex, you can live in one side and you can rent out the other side as a short-term rental. Same thing with a triplex or a fourplex. If you're going to purchase this as an owner-occupied property using an FHA loan, you have to live in one of the properties. Right? And then you can rent out all of the other properties as you wish. Now, same thing with a VA loan. You cannot use a VA loan for an investment property unless it is a multi-unit property up to 4 units. The great thing about a VA loan is you can do VA loans with 0% down. For an FHA loan, you have to come up with 3.5% down payment. And then you can also do conventional loans. Now, you can do a conventional loan on a single family property. You just have to disclose that it is an investment property, that it is not a primary residence. There are first-time homebuyer programs available if you're living in your primary residence, but you cannot use first-time homebuyer programs, conventional programs, if it is an investment property. So a lot of the major difference in these traditional financing options is in the down payment. So as I said, FHA loan, you have to come up with a 3.5% down payment plus closing costs. VA loan, you don't have to have a down payment. You do have to have closing costs still. So you always need to factor in that no matter what you purchase, you will have closing costs. And then if it's a conventional loan, if it is a single or a duplex, you can do those for as little as 15% down, depending on the lender. And then if it is a 3 to 4 unit property, you're probably looking at more to 20 to 25% down. So for conventional loans, really anywhere from 15 to 25% down, depending on how many units the property has. There are times when a home buyer is unable to be approved for traditional financing. So when that's the case, we do have other financing options. Now, you always want to check and see if you can qualify to purchase the home with a conventional loan. Traditionally, conventional loans or FHA or VA, if you do plan on living in the property, the conventional loan programs, though, and traditional loan programs will have lower interest rates. But if you don't qualify using the conventional products or the traditional products, we do have some investor products. With that said, let's just go over the 2 primary investor products, which are for investors. And also, if you're an owner-occupied investor and you want to use rental income to qualify for the investment property, we have a no-ratio loan program. And we also have the DSCR, which is the debt service coverage ratio loan program. So what does that mean? Debt service coverage ratio or no ratio. It really just means that we're not going to verify the borrower's income. You do not have to do income. You don't have to submit pay stubs and W-2s. Basically, the property qualifies when we assess the rental income. And so there's no need to turn in employment income on your application. There's no need to collect all your employment documents. We don't have to order verifications of employment. But these are a much riskier loan for the lenders. So to mitigate the risk of not requiring employment and income, there's typically higher requirements for down payments. There are expectations that you have more cash reserves, and you typically have to pay a higher interest rate. So depending on the subject property and the home buyer's financial stability, and we do check credit. So when I say no debt, we don't check the DTI. We do still check credit scores. And so you have to, and we check your availability of assets, and assets do have to be seasoned and sourced. So minimum down payment on these is usually 25% of the purchase price. And then you're going to probably be paying higher interest rates. So if this is something that you're interested in, let's first see if we can do a curated path to get you to traditional financing. And the other thing that I forgot to mention before is with conventional loans, you can do up to like 8 to 10 conventional loans. And then, so if you want to buy a multiple investment properties, maybe you max out on conventional and then you move over to some of these debt service coverage loans. But even with conventional financing, when you start doing multiple rental properties, you will have to be able to show reserves for both traditional and non-traditional financing. Now, using rental income to qualify. How can we use rental income to help qualify for the mortgage? Now, this is going to vary depending on the loan program. So I know that I'm talking about short-term rentals, and unfortunately, it is more difficult to use potential short-term rental income. So even though we can make a lot more income on these properties if we're doing short-term rentals, if we want to use the income of the rental to qualify, then we're going to order a rental appraisal, and that's going to be typically based off of long-term rentals. So what is the fair market rent for that property? And so we can, for FHA, VA, you'd be able to use the owner-occupied multi-unit properties. So you would live in the one unit. What is the fair market rent that the other units, if it's a duplex, triplex, fourplex, what is the rent that those other units could make? And then typically we can only use 75% of that. Now, with that, if you already own a rental property and you have been collecting rent for 2 years and you show that rent on the tax return, so if it's a short-term rental or if it's a long-term rental, if you've got 2 years tax returns documenting that rental income, then we can use all of the rental income as qualifying. But if we don't have 2 years of tax returns to show that full rental income, then we do a rental appraisal and we use 75% of the potential rental income, and that's based on a long-term rental. So you can use the rental income, though, to help you qualify to purchase these properties. Now, one strategy that a lot of investors will use to free up more cash in order to get into these short-term rentals and these properties is if you already own a home, whether you own a primary residence or if you already own rental properties, you can tap into the equity of the properties that you already own and use that equity to purchase a short-term rental. And so if you need to come up with that 10, 15, 20, 25% down payment, whatever it is that the loan program you're using requires, you can do a HELOC or a cash out refinance. So let's talk about a HELOC first. A HELOC is a home equity line of credit. Basically, it's taking out a second mortgage on your home. And so like if you already own your home, you can take a second mortgage out on your home. And a line of credit kind of just acts like a credit card. You get granted a line of credit and you use it if you need it. Otherwise, it just sits there as a line of credit. You can pay it off and then you can borrow against it again. So you can use up to 85% of the equity of it using a home equity line of credit. Now, the risk with a home equity line of credit typically is that most often the interest rates are variable. And so if those interest rates go up a lot because of market conditions, then that could be a little bit riskier. So the other option, if you don't want to have a variable interest rate and you don't also want to have a second mortgage payment tacked onto your first mortgage payment, the other option is to do a cash out refinance. Now, a cash out refinance gives you the opportunity to have a lower interest rate You can take the equity out of your property. And so basically you would replace your previous mortgage with another mortgage, and the new mortgage that you would take out would be higher than the old mortgage. So you pay off the old mortgage, and then you get the cash difference to use to invest in another property. So if I'm not explaining that really well, and you're interested in this, give me a call. And if you're confused, let's talk about it, because it really is a great tool to free up cash to purchase more properties. So typically with a cash out refinance, you can do this with a conventional loan. You can do this with a VA loan. With a conventional loan, the maximum that you can take out is 80% of the appraised value of the property. With a VA loan, you can do 100%. I don't know that I would always recommend that, but you can basically tap into 80% of your home's equity and take out a new loan for 80% of 80% of your home's value. You can take out a new loan for 80% of your home's value. So I know this can be a little bit confusing if it's the first time you're hearing about this. I will tell you that I have been a real estate investor since probably 2012, 2014. And the first time I heard this, it almost might make your head explode, right? But then you really just start learning and understanding. And I will tell you that I have done multiple cash out refinances on my primary residence in order to buy more investment properties. It has been my investment strategy for the last few years. And because of that, I've been able to buy more investment properties than you would. And I don't have to sell my properties. I can purchase more properties. Those properties then bring in more rent. And then you can even do cash out refinances on your rental properties. So some of you might be thinking, but then I'll never have the property paid off. And that's a whole different investment strategy. But paying off your property is 100%. But just always being able to utilize the equity in your properties to purchase more properties, then you can purchase more income producing assets. So it's a really great tool, really great mechanism to just buy more assets that are going to make money for you, and you can make that mailbox money. Whether you're doing it with short-term rentals, whether you're doing it with long-term rentals, investing in real estate is really one of the best investments that you can make. And you just want to educate yourself on the ins and outs of it. So I'd love to be a resource for you to help you figure out what it takes for you to purchase your first investment property. And that can be a short-term rental. That can be a long-term rental. So that's what you look for in your loan officer. So as your loan officer, I'm going to listen to you. I'm going to really try to understand completely what your goals are. And then I'm just going to lead you in the right path to help you make an informed, sound financial decision that would lead to making more income and freedom, financial freedom for you and your family. So anyway, thank you so much. That's all I have for my presentation. Again, I want to talk about my company, Best Life Mortgage. So I am a broker. My company does have access to about 20 different lenders. So I have access to a whole bunch of different loan products to help you meet your needs. And so I can shop for you. The other great thing about my company is that we are a tithing company. We are called Best Life Mortgage because we want everybody to live their best life. But we give 10% of our corporate profits to a company called Destiny Rescue, which liberates kids from the shackles of human trafficking. And so I just feel very honored to be a part of a company that gives back and helps create a better life for these children who are victims of such terrible, terrible circumstances. So I'd love for you to be part of that mission. Our goal is to liberate 500 kids a year from human trafficking. So I'd love for you to be a part of that. I'd love to help you lead your best life by investing wisely, making some great investment decisions. Let me put my info out there. There is, let's see, my banner. So yeah, my phone number is 210-279-4392. You can reach me at ericabelay@bestlifemortgage.com, or shoot me a comment or a message if you're watching this on Facebook or LinkedIn. Just reach out. I'd love to help you. Thank you so much for tuning in. Have a good evening.